The following presentation by Monument Capital Management LLC is intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Monument or any other investment professional of your choosing. Please see additional information disclosure at the end of this presentation. A copy of Monument's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.monumentwealthmanagement.com.
The point of a portfolio is never about more. The point of a portfolio is long-term systematic growth that gets you that high percentage of probability of success and gets those goals that you have funded. Okay, welcome back to our Off the Wall podcast. This is where we like to affectionately say we're talking about all the things that Wall Street isn't talking about, or at least some of the things that Wall Street isn't talking about. And today I'm joined in person, live from our global headquarters here in Alexandria, Virginia, during what we call our Surge Week. So I have Erin and Nate with me live in the studio. So Nate, Erin, say hey to everybody.
Well,
hi, everyone. Good to be here.
Right? It's kind of weird. I feel like I can lean over and actually shake both your hands.
Right. So anyway, welcome to this first ever in live Off the Wall. Excited. Today we want to talk about something that is an interesting topic because a lot of people think they know about it, but then when you dig in on the topic, sometimes people really don't understand a lot about the different indexes and why you do and don't use them for performance. So before we get going, I'll just say it's really important to make sure that we're talking about apples to apples, right? So how do you know as an investor if your portfolio is doing well relative to the market? And I'll just use a quick example. So I always find myself talking about the Dow Jones Industrial Average. And the reason I do that is because it's on TV every day. Most people know about it. It's a very common, but in actuality, it's not really a great index to use because it's price weighted. So of the 30 stocks, the stock with the highest price per share is going to carry the most amount of weight. So does that really line up with your portfolio that's well diversified and could have exposure to literally thousands of stocks if you're an ETF investor? So we just want to make sure that we have a good, solid conversation about what indexes mean, what they should be used for, what they shouldn't be used for, and how they should apply to you. So Nate, why don't you give us a quick breakdown of some of the major indices and we'll just kind of take it from there.
Yeah, I think, Dave, you started out with the Dow Jones, which is the oldest one, and you can't really read or watch financial media, financial content without hearing about kind of the big three, let's call them indexes. Right. The Dow Jones is obviously one. Just to kind of start with that, as the name implies, it's the Dow Jones 30. There's 30 stocks in it. But back in 1896 when it started, so it's been around a long time, there were 12 companies that they were reporting on. Now then there weren't as many companies listed, but still overall, it's always a very concentrated index on only a handful of names.
Right. But they're the ones everybody knows.
It seems like it. But I mean, we'll get into maybe some pitfalls around it because I think you touched on a few of them. It is the one that seems to be reported on most frequently in the media. I think the other one you hear a lot about consistently is S&P 500.
Sure.
Which, interestingly enough, while the Dow Jones 30 is 30 stocks, the S&P 500 is actually 505. So it's not a perfect comparison, but it started with 500 companies. It's now slightly bigger than that, but that one's been around since 1957. But Standard & Poor's, which is what the S&P stands for, has been publishing since 1923. So again, these are why you hear about them. They've been around for so long, it's almost unescapable. And the final one you hear about, the newest one, quote unquote, is been around since 1971. So what is that, still almost 50 plus years now? And that's the NASDAQ. And the NASDAQ is a trading exchange like the New York Stock Exchange. And so that index captures everything traded on that NASDAQ exchange, over 3,000 companies. However, it's always key to point out, they really do have a NASDAQ 100, where they're only reporting on the largest 100 companies that are the most traded. And I think it's kind of very interesting to talk about it specifically when we get into maybe talking about how it compares to your portfolio. You got to remember, these indexes are all US based on large cap companies, but that doesn't mean it's the same companies. And Dave, you kind of touched on it, which we can dive into here, but there's a lot of difference in what companies are held in the indexes and how that then reflects in the performance that you hear reported.
Can I let you guys know, regardless of the index, This is something that usually applies just to the Dow. And FYI, this is my own pet peeve, and I apologize in advance if I'm going to be offending anybody. I can't stand it when people quote the Dow Jones in points. It means nothing to me.
Right.
It's like someone coming to me or coming to you and saying, I'm going to use this stock specifically, and you'll see why in a second. Oh my God, Berkshire Hathaway dropped 1,000 points today. That sounds like apocalyptic, the end of the world.
Right.
Do you guys know what Berkshire happens to be priced at in price per share?
It depends on the share class, but it's a high price.
$797,000. So 1,000. What I'm getting at is, I think it's sort of an antiquated mindset of quoting indices and points, and it usually just happens with the Dow for whatever reason. But when you get into talking about these indices and looking at performance, whether it's usually people talking about daily performance when they're talking about points. But it's definitely much better to be talking about changes to indices in terms of percentage versus in points. That's just my own little pet
And a
peeve
lot of
right
people,
there.
you'll see those charts that come out too. They'll say like, how much between each 1,000-point move in the Dow did it take on a percentage basis? And, back in the old days when I was growing up with the stock market, if you saw a 400-point day on the Dow, you're like, whoa, holy cow. Now it's a 1% move.
Exactly.
So the difference between going from 39,000 to 40,000 to 41,000, the percentage that needs to change there is just getting smaller and smaller and smaller. And pretty soon we're going to see 10,000-point days and it will be like 1% move,
Well, and the financial media does that for the same reason the financial media does everything. Guess what sounds a lot better than the Dow fell 1% today? The Dow is down 400 points.
Right.
400 sounds bigger than 1%.
Yeah.
So what do you get? Clicks? Those very simple things.
Or you see CNBC in the morning, they're like, futures are off sharply today. And you look at it and it's like projected to open up 90 points down or something. You're like, oh, geez, come on. So
Yeah, well, and I think that's what's so difficult for investors, for clients, is so many people, they don't spend all day in this kind of world like we do with our clients and with our clients' portfolios. So a lot of these things that the media does, or that I think we think maybe is common knowledge, really does get into why we want to cut this episode.
right.
Is we constantly deal with questions about, well, is the market doing good or bad? Is the market, is my portfolio doing good or bad? And it is a much more detailed conversation. I think, Dave, you hit on one of the big things. One of the reasons why the Dow is so different than the S&P 500 is the Dow gives the highest weight in the index to the companies that have the highest price per share. Well, the S&P 500 doesn't do that. The S&P 500 gives the highest weights to the largest companies, market cap wise. So not price per share, but how much is the market cap of the company?
Nate, let's back up for a second. So for someone who's not familiar with market cap or market capitalization, how would you explain that to someone from just a very basic view? Like what's the calculation involved there?
So the simplest way to explain it without using any math, because I know not everyone loves math, is it's just the largest companies. Think your Apples, your Nvidias, but really what you're looking at is their price per share times their shares available to get the total
Shares
market
outstanding.
cap. Shares outstanding. Yep. So the companies that basically overall is kind of how I would say is the easiest way to value a company. It's the most simplest. There's not much math behind it. You say this company has a market cap of X amount of billion or trillion. I think we've had even a handful of those. But those are the companies, think your Apples, your Nvidias, the Microsoft, the Mag 7. Well, what's interesting is while those have some of the highest weight in the S&P 500, the companies that have the highest weight in the Dow, 3 of the top 4, Goldman Sachs, United Healthcare, and Home Depot.
And that's just because their price per share is higher than the number 4 and 5 and 6 in the index.
Not because they're more important,
Right.
and I'm using
Or
air
even
quotes for
bigger,
anyone on video.
Or even bigger.
Then it's just because they have an arbitrary price per share. They've been along for a long time. Their prices have gone up.
Right.
They haven't done any changes to the price per share. Not a topic we'll get into today, but you can do things to reduce your price per share, which Amazon and other companies have done.
Right.
But what's really important is those 3 companies are 20% of the Dow. So if you look at the Dow, not only do you get the 400-point moves, you're getting 20% of the performance of that index is related to 3 stocks, which I can make strong arguments are not that relevant to the U.S. economy or its long-term growth. And those 3 companies I named, United Healthcare, Home Depot, Goldman Sachs, less than 2% of the S&P 500. So which index do you want to look at? Do you want to look at the one that overweights maybe those 3 companies? Is your portfolio overweight those 3 companies? Or is it more broad market, maybe ETF diversified based. So it's just kind of interesting how that breaks out.
It's also interesting from a behavioral perspective, an investor behavioral perspective, because you never hear anybody say like, "Oh, I bought an ETF of the Dow Jones," right? Because it's 30 stocks, right? Everybody says, "Oh, I own the S&P 500 ETF." Makes a lot more sense, but still, everybody talks about the Dow all the time. And the converse to what you were talking about with the Dow is that the S&P 500, which is a market cap weighted index, which instead of the price being where it ranks, it's how big it is, price per share times shares outstanding. And you start to get this divergence that we've seen lately, and this is where you're getting the Mag 7, that we're talking about the Mag 7, that the top 10 stocks in the S&P 500 are driving a huge amount of the returns of the overall S&P 500. And so, yeah, you own 500 shares, or 500 different companies, but really, you're kind of concentrated when you're an investor in just the S&P 500. So it's a different sort of, you were saying Goldman and United Healthcare, that's one way to be concentrated, but in the S&P 500 has the same problem, but just different.
And you want to know where that problem's even worse? In the other big three,
right.
The other big third index,
those,
right?
Yeah.
And so we can talk about the NASDAQ, which you talked about is the one that has 3,000 companies.
Which, by the way, I'm older than the NASDAQ. I just want you guys to know, even with my awesome hair, but yeah.
It's just kind of, I think I'm older than Google, which is a weird thing to think about if I did the math correctly. But I mean, the NASDAQ I just said was 3,000 companies. You would think that'd be the most maybe diversified. Well, there's 3,000 names. Well, guess what? It is 50% in the technology sector of the U.S. economy. So 50% of the index is just tech companies. We talk about the Magnificent Seven stocks, the NVIDIAs, the Metas, everyone knows their names. 50% of the index is just in the tech sector for the NASDAQ. 15% is communications. That's where Google, where Meta is. And then finally, 14% is in discretionaries. Amazon is the big one in there. Amazon and Tesla, I believe, are the two big names in that sector. So right there, I just gave you 80% of the index is exposed to those risk-on, very kind of growth-focused names. That's not the case with the other indexes. So you want to compare your performance to the NASDAQ? Oh, the NASDAQ has done so well. There's a reason for it. Yeah. But you got to know what is made up underneath that is pushing these indexes.
That's a really important point with the NASDAQ vis-a-vis especially the S&P 500, Nate, which when you look at the NASDAQ 100, which the popular ETF that tracks that, of course, the QQQ, there's a lot of differences between sectors as well, and you just pointed that out. And an important thing with the NASDAQ is these are the largest non-financial companies on the exchange. So you're not getting exposure to banks or financial services in the NASDAQ through those ETFs. Mm-hmm. I believe they do trade on the exchange themselves, but the actual NASDAQ 100 is going to exclude those financial services companies. And I could be wrong on this too, but I believe it doesn't have much, if any, in the way of utilities and some of the other defensive sectors as well. So it's definitely predisposed and biased towards what you would call potentially higher growth sectors within the overall U.S. stock market.
Yeah. And I think kind of a question we always get is, well, which one do you look at as an investment professional? And so, again, if I'm looking at what is the health of the U.S. stock market doing, I'm looking at the S&P 500. I know it has concentration risk in some of the names, but it's more diversified than the Dow. It reflects the companies that I think drive U.S. growth without being so overweight them like the NASDAQ is.
Now ask me what I follow.
All right. What do you follow, Dave?
Yes. Because really, okay, S&P 500, always watching that, right? But I'm also always watching the Dow because it's just the common language, right? However, I find one of the most fascinating ones to keep an eye on also is the S&P 500 equal weight. Because if you really want to see what's happening in the market at a glance, look at how well the S&P 500 did for the day, and then go look at the S&P 500 equal weight ETF. I can't remember the ticker off the top of my head, but RSP, right? Thanks. Look at the difference between those two things, and you can see a massive divergence even on a daily basis. But on a year-to-date or even a trailing 3-year, if you look at any of those numbers, you can really start to see, like, why is the equal weight underperforming the S&P 500? Okay, answer, because the Mag 7 are rocketing, and then the other, 400 and some odd, depending on 505, whatever. The rest of the market is not doing as well. And so when you look at it on an equal weight, you can really start to see how heavily weighted the S&P 500 returns are to those big stocks.
Yes.
At a glance.
I'm just going to change my answer then to Dave's. I like that better because equal weight, as the name implies, it doesn't overweight companies by market cap or it doesn't weight them.
Right.
Every company in the S&P 500 gets the exact same weight in the index.
1 divided by 505.
So if you want to see how the average stock in the U.S. market is doing, especially in that large cap space, remember S&P 500, U.S.-based large cap, equal weighting them removes that impact.
Right.
Aren't you guys going to ask me what I track?
Of course, we were just about to go there. It was on the tip of my tongue. Erin, what do you track?
This is actually both. So the S&P 500 and S&P 500 equal weight, and specifically not tracking them individually, but creating a ratio between the two, because I think there's a lot that can be gleaned from tracking the ratio or the relative performance of one versus the other.
Mm-hmm.
You'll often hear this talked about in terms of this analogy of generals and the troops. So think of the troops usually follow the generals, or if the troops abandon the generals, and the analogy extends to you've got your largest in the upper echelons of the S&P 500, the largest names being the generals, and then the troops, so to speak, being the rest of the index. And you can see that play out with the S&P cap weight versus equal weight. So if you see that the S&P equal weight is outperforming cap weight S&P, however you create that ratio, you could say that the troops are actually, following or actually leading their generals into battle.
Mm-hmm.
And the opposite is true as well. So generally looking at that ratio can give you some degree of market participation and
Mm-hmm.
market breadth. You'll often hear that, the S&P 500 was up today, but the average stock was down. So that's not always a great thing, of course, to see just a handful of names carrying an index. And that's a very widely tracked metric to see, hey, how healthy is the stock market actually? Is it everyone participating, or is it just a handful of names that are carrying the market?
Let's talk about relative performance.
Yeah, I know. We just gave a whole history class on what these indexes are and the breakdown, but really what I think matters to investors is how do I tell if not if the market is okay, how do I tell if my portfolio is okay?
Right.
And really, unless your portfolio allocation is 100% US only, large cap stocks, the big 3 indexes you see on the TV or in the newspaper don't really help give you a measuring stick on how your portfolio performance is. So many portfolios we have here with clients are not necessarily always concentrated on US stocks. They aren't 100% in stocks. There's bonds, there's cash. So really what you have to do, and I think you said it at the jump there, Dave, you have to compare apples to apples, not apples to oranges. Right. And if you're comparing your portfolio to one of those big 3 indexes, you're probably comparing oranges to apples, apples to oranges. So I think the first thing for anyone to do is make sure you know how you're invested. Just broadly, are you stocks, are you bonds? What's your breakout? Are you 70% stocks, 90%? Because all that's going to inform how you measure and review your performance. And if you have an advisor, they should definitely be talking about that with you. They should be talking about how you're invested to help give you an idea of how to measure performance. If you're doing it on your own, you're going to have to do some digging, but it should be on your online portal with whoever you're trading with, whether it's Robinhood, Schwab, Fidelity. They all should have that kind of information for you. And, if you really feel like you need a second opinion on either your portfolio, outside portfolios, that's what other advisors like we do here at Monument for the clients all the time. Because that's how you start this whole conversation is how am I allocated so I can measure that kind of performance? Because again, if your portfolio isn't 100% stocks, you're not going to perform as well as a 100% stock benchmark or index.
Right.
Risk reward.
Because a lot of times, I shouldn't say a lot of times, many times throughout my career, I have heard people who have come into Monument to learn more about us have said, my investment objective is I want to outperform the S&P on the upside, but I don't want to do as bad as the S&P on the downside. And I look at them and say, okay, so as a baseline, you want to have 100% of all of your money in stocks, right? As a baseline. No, that doesn't seem safe. It doesn't seem prudent. So there's that disconnect right there. It was people they map their expectations to what they see in the S&P 500, but they don't necessarily call it your apples or oranges. They don't carry it back over to what the reality of their portfolio should look like.
Yeah. And it's about, again, I think it's something Erin and I talk about all the time too, is the risk of your portfolio, that should match up with the risk of your benchmark mostly. And then you can't compare a extremely risky, because even within stocks, Growth stocks, riskier than dividend stocks. If you have a dividend-driven portfolio, you should be looking at a dividend-focused universe to measure your performance. At Monument specifically, I mean, there's a few ETFs I know we look at to really kind of measure the different performance in different buckets. You know, for dividends, we look at, I'm going to say some tickers here so you can, at home, can look them up on your own, but tickers NOBL and ticker REGL, which are dividend aristocrats, meaning companies that pay and grow their dividends over long times. Those are the only companies inside those ETFs, and that's a good way to kind of get a broad look at how dividend-paying stocks are doing. Conversely, you want growth stocks? Pull up the Russell 1000 Growth ETF, which is the Russell 1000, so U.S. large-cap stocks, but only on the growth side, ticker IWF.
So I know we might be introducing some new names and new index providers in here, but I would say, we covered the big three as well with the Dow, the S&P, and the NASDAQ. I mean, we can't forget the Russell as well. I mean, Russell is a very large index provider, and so alongside the S&P 500 and the NASDAQ, but more so the S&P 500, you're going to hear people throughout the Russell 1000 index. So if I had to go take the Pepsi challenge, so to speak, between the Russell 1000 and the S&P 500, it's very difficult to do if you're an outsider, and even for a lot of professionals. Like if you line up a portfolio and give, without names on it, and the portfolio breakdown and the stats, unless you really know what to look for, like with the Russell 1000 and the S&P 500, they're very, very similar, but there are some key differences. So just wanted to throw that out there since we're talking Russell now.
Well, and again, it's how you measure your performance. There's no right or wrong way. And you can look at both to see, are you in the ballpark? Because again, I think if you have global equities, that bleeds into everything. You should be looking at an index that has global exposure. You shouldn't be comparing your portfolio to a U.S. only base. And so I think there's a lot of different ways to do it. We name some ETFs. We look at all these different kind of indexes. But again, I don't think we're ever so hyper-focused on this strategy has to beat this index, because that's really not what investing is about. I know you always want to beat the benchmark, but A, that's really hard. And B, most of the time within a financial planning firm, within our firm, I would think, I know, Dave, you can speak on this, is for years, you're really just trying to achieve long-term performance that makes your plan successful.
Right. And really, to put a finer point on that, if you're asking, if you're suggesting what people should follow for a benchmark, in my mind, it's this. Every investor should have a financial plan, and that financial plan should give everyone an idea of a probability of success of their portfolio. And the probability of success of a portfolio, you want it to be very high, and it will have some sort of computed growth rate. So, for example, it would sound something like this. Your plan has a 90% probability of success if you achieve a long-term growth rate in your investment strategy of 7%. That's your benchmark. I mean, forget it. If the S&P 500 is up 25% a year and you're up 8%, you beat your benchmark. Could you have done better? Yes, but that's not the point. The point of a portfolio is never about more. The point of a portfolio is long-term systematic growth that gets you that high percentage of probability of success and gets those goals that you have funded. So people can get really out of whack with how they're looking at, well, the S&P was up 25%. It was up over 20% for 2 years in a row, but my portfolio was only up 14% every single year for the past 2 years. Why is that? Well, because you probably have a portfolio that was set up for a 7% return in a 10% long-term, rate of return investment strategy, and that's why. So everybody listening to this should also remember that your real benchmark is what your plan says your assets should be growing at, annualized over a long period of time.
Yeah, my favorite clients are the ones that understand that concept.
Yeah, right.
It's the most difficult conversations I've had in my career is trying to explain that to people. Right. And if you can get over that hurdle, and I think it's something when we, early on in my career, talking about not really what is the target index, like you said, it's what is the target return that I need. Do I need 6% annualized over the long term? And that means in any given year, you may have a little bit more than 6, you may have a little bit less than 6. But that's the markets.
Right.
That's volatility.
Here's the question we never hear. We never hear this from a client. Dude, I'm supposed to be getting a 7% rate of return annualized over the course of the long-term strategy. And when I look at my performance, I'm annualized at 12%. What the F are you doing? You're taking on way too much risk. No one ever says that, right? But that's a really legitimate question, which is, hey, why is my rate of return so much higher than what I planned for? Because in reality, it probably means that I have taken on more risk. Now, the answer to that is likely, hey, we just had a really good run in the market for a couple of years. I mean, there's always an answer, but like we never get asked that question.
No.
That's fair.
I think it gets into return chasing.
Yeah.
I think a lot of advisors are so terrified of underperformance that they will put more risk in client portfolios. They'll put it there just in hopes of getting the higher return. And guess what happens when risk doesn't work? Because we
just lived it for 2 months.
Exactly. And we've lived it before, 2020, 2022. Like, it's not a new thing that risk sometimes does not work. It's about making sure that we can manage client risk profiles to help them stay invested.
Right.
Because guess what you're not going to do? You're not going to, if you pull your money out of the market and never go back in, you're not going to get index-like returns.
Yeah.
You may not even get your target return.
What are some other, common performance calculation pitfalls that we've come across? Because that's kind of it. That was the intro to that question, right? Let's talk some more about that. 'Cause it's kind of interesting.
I mean, the first one that always jumps out to me that I think a lot of clients underappreciate is money coming in and out of the portfolio.
Yeah, that's a big one.
Sometimes money comes in when the markets are at the all-time highs. It's long-term money. It's meant to be invested for 10 years, but let's say you invested in 2025 in early February before all the volatility started. Your return may not look great right now because of how the market's peeled back, but in 10 years, your return's going to look very different. But it's always going to be impacted on when money goes in or out of the portfolio. And out is really the bigger one because most of the time, clients are hopefully planning ahead for cash needs. We do a lot of cash planning. This is something we deal with in performance reporting.
So Nate, let's put some language around this. I know there's some official terminology for these types of measuring this return when you're taking into account your cash flows, taking money out and putting money back in. So talk to me a little bit about that.
Yeah, because there's two ways to calculate returns, and this is getting a little bit in the weeds, so I'm going to keep it high level and people can do their own Google searches. But for a long time, there's a performance return called the internal rate of return, or IRR, that is impacted by those flows. Mm-hmm. So money coming in and out will change the performance metrics and can change them quite significantly.
Yeah.
Performance standards across the industry have really moved to what's called a time-weighted approach. And the math behind that really does help remove some of the impact.
It smooths it.
It smooths it. And that's a dangerous word in the investment world.
I know,
but
people understand.
It does.
It's the underlying return of your manager or of your investments, and not necessarily
Correct.
when you decided to put money in and to take money out.
Right, because a quick example of that is if you called us up on February 15th and said, I need $100,000, you essentially took $100,000 out at the top of the market. Great. If you called us up at the end of halfway through April or even now and said you need $100,000, well, you're taking $100,000 out when the portfolio is down 10% roughly, and now you take that money, you just took gas out of the engine that you'll never probably put back in, and that's going to really impact the recovery of the portfolio. And so the time-weighted rate of return is going to smooth those decisions that are made by the client or the investor taking money in or putting money out. Or, sorry, that didn't sound right, but you know what I mean. Yeah. Taking money out, putting money in, and it's going to smooth those decisions that the investor is making.
Yep. Here's a really famous historical example to put a finer point on that, Dave. So one of the most famous mutual fund managers of all time, I'm sure you two have heard of him, I know, but Peter Lynch. So if you're listening or watching this right now, Peter Lynch ran the Fidelity Magellan Fund for, I want to say 15 years in the late 70s through I think about 1990 or so.
Yeah, then he became an author and started making money that way. So
yeah exactly. But legendary investor, and he had some of the best performance throughout at least a decade. And I don't know his exact performance stats, but call it high 20%, high 20s annualized. Actually, I think it was closer to 30. Yet they did some calculations of investors in his fund. They actually managed to average negative returns over that same time frame. So how can you have a manager that's averaging nearly 30% a year for a decade, yet the actual clients that are invested in that fund have very low, if negative, returns? It gets to those two different
time and
performance
cash flow
standards.
times.
Yeah.
Yeah, and I think it's important if you're an individual investor, if I'm the client, you want to look at what kind of the impact of your decisions to take money in and out. So the internal rate of return can be very appropriate if you want to look at your portfolio. If you're evaluating an investment manager, so how does Monument do? We want to show you our strategy without those kind of decisions because they are often mistimed. As much as we preach to raise cash in the good times, make sure you have that cash to ride out the bad times. Unfortunately, we have clients that either have emergencies come up or, God forbid, maybe didn't take our advice to the fullest extent. And we'll continue to give them this advice forever and ever and ever and ever. But flows are always going to impact your return. Even if you do the time-weighted return, taking out large pieces of your portfolio, there's no way you can smooth something that is that jagged.
Now, I'll throw this out as a quick commercial. If anybody listening to this is sitting on a bunch of cash because they just sold their business and you're thinking about hiring Monument, please call us right now. because 5 years from right now, all of this volatility and everything will have erased itself out of the system and you won't even know, and you'll be very happy that you actually did. So there's some benefit to putting money to work when the market's down. I mean, right.
There is.
Yeah.
There is. I mean, there are benefits. And then again, it's not saying that this is going to be the absolute bottom, but hey, putting money in when things are quote unquote on sale can really impact your long-term performance.
Right. So 703-504-9600. Yeah. Okay.
Well,
Nate, talk to us, like, kind of related and shifting gears on performance. Like, I think people know, all right, a stock, the price goes up. Like, I can track that, but I think most people know, but maybe some people don't or don't appreciate that stocks also pay dividends as well.
Mm-hmm.
Stock and exchange traded funds and mutual funds. But so you've got prices and you've got dividends. So let's talk about that aspect of performance reporting.
And I think that's a key one that if I'm ever looking at performance from another advisor or an online portal, make sure you're looking at what's called total returns. And not many people may or may not know this, but there's two pieces to your return. How much of is price return? So how much did your investment grow? You bought it for $5, it goes up to $10. But arguably equally important is how much income was generated along the way too, because both of those contribute. If you got an extra $2 of dividend income or interest income from a financial investment, your return is now not $10 at the end when you sell it, it's $12 total. Right. So you need to factor in both pieces, because for dividend paying stocks, they may not have as high of price appreciation as growth stocks over time,
Mm-hmm.
but you've been collecting dividends hopefully along the way from those.
And people forget that because a lot of these online, like if you go to Yahoo Finance or something, they're generally showing price performance. So an example is if you bought a stock on January 1st for $50 and on December 31st it was worth $50, your price return is zero. But if it paid a 5% dividend, you made 5% on it. Just you don't see it in the $50 per share.
It may not look like it. And I think
it doesn't look like it,
and
right?
on your cost basis, if you're doing taxable accounts, they usually, that even gets more complex, but you got to look at the whole picture. And again, like we were talking about with how does returns fit into your target return fit into your financial plan, that's a comprehensive look at how is my returns impacting my financial life. Right. Well, looking at both price and income returns to equal your total return, that's the whole picture of how much money your investments are making. And so it's again, performance is such a convoluted topic. We hear about it from clients all the time because it does really matter. And we're always happy to answer these questions, but there's just so many common questions we get from our clients that I'm glad we're cutting this episode in person today, because we hopefully can address these just common questions, pitfalls around total returns, around flows, around how do I measure my performance. It's not about an index. It's about what matters to make your life successful.
And not to overcomplicate it, but there's also knowing the difference between your performance net of fees and gross of fees. So you'll hear people talk gross of fees. That's before fees, gross, and your net is what's after the fees get paid, and those can be two totally different things.
So, Nate, as our resident performance expert, how do we report performance here at Monument?
So at Monument specifically, I mean, to just hit Dave's point, because I think it's a very important one, always showing net returns to clients. Monument does have fees that are associated with its services. No good thing is for free, and I would like to think what we offer is a very good thing. Compliance warnings and all the disclosures, but we do a lot of work for our clients. So showing them the net of fee performance, I think, is so important. So clients really know how much am I actually taking home at the end of the day in performance. And again, look at what I was talking about a little bit earlier. We can show clients those smoothed out time-weighted returns, but we want to show clients the impact of the money that they have decided to take out of the portfolio. And we're cash-based planning. So we show the internal rate of return, that IRR.
What you actually experienced.
Exactly.
The client actually
and
experienced.
that's really the goal of performance reporting, and is really making sure that clients can understand and see to what we believe is the clearest way of what did you take home at the end of the day from returns.
Well, thanks, guys. This was great. I'm glad we got a chance to do this in person. This was a lot of fun.
Yes.
And thanks for everybody for watching. Be sure to follow us on our YouTube. I mean, this is our in-person. So obviously the video, if you're listening to this in the car, there's also a video attached with this. And if you're watching this on YouTube, I'm sorry, I'm so ugly. And but this has been really great. A couple things. So mention the YouTube channel. Make sure you're subscribed to that. We also have a great website. And if you go to that, it's monumentwealthmanagement.com. You can find all sorts of links there to the blogs that we write, to this YouTube channel, to the podcast, which is, Spotify and iTunes and all of that. And then I think actually more importantly, we have a great newsletter. So if you go to the website and you sign up for that, I know everybody says, hey, sign up for our newsletter. I think our newsletter is pretty good. It's got a lot of good stuff in there. There's some current stuff in there. There's some evergreen stuff in there. So check that out. And here's my promise to you. If you don't like it and you click unsubscribe, you'll be unsubscribed. So.
And you'll get private podcast episodes too.
That's right.
It's not just the newsletter.
Not just the newsletter, right? You get the extra stuff. You get to listen to us even more.
Yeah, and we'll try and be prettier for the next video.
Yes, exactly. Right. Right. Okay, well, with that, everybody, thank you very much, and we'll see you on the next episode.
The previous presentation by Monument Capital Management LLC was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Monument or any other investment professional of your choosing. Different types of investments involve varying degrees of risk. It should not be assumed that the future performance of any specific investment or investment strategy or any non-investment related planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Monument's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Monument is engaged or continues to be engaged to provide investment advice services. Monument is neither a law firm nor an accounting firm. No portion of its services should be construed as legal or accounting advice. No portion of the video content will be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Monument is engaged or continues to be engaged to provide investment advisory services. A copy of Monument's current written disclosure brochure discussing our advisory services and fees is available upon request at www.monumentwealthmanagement.com.